Gold just sent a message that most retail traders completely missed. Look, while the retail crowd is out there aggressively chasing emotional breakouts and reacting to flashy news headlines, institutional capital is operating in complete silence. Today, we are decoding the exact footprints left by that institutional capital in the gold market. We'll be breaking down the macroeconomic environment and dissecting the commitment of traders' data so you can see exactly where the real money is positioning. We're moving way past lagging indicators to read the raw tape of algorithmic delivery.
The chart tells one story, right? But the institutional money, it always tells another. Retail traders frequently look at a sudden, violent drop in price as a prime opportunity to buy at support. They're trying to catch falling knives. But here's the reality. Large institutions can't just execute massive sell orders at market price without causing severe slippage. They literally require counterparty liquidity. So smart money sees that exact same panic drop as a premium manipulation. It's designed specifically to fill massive short orders. They need retail traders to buy in order to provide the liquidity necessary to offload their heavy distribution. If you want to understand true market direction, you have to stop reacting to the chart and start anticipating the liquidity.
In this briefing, we'll be covering the macro setup, smart money positioning, institutional market structure, liquidity and PD arrays, and finally, the execution plan.
Let's jump right into Section 1, the macro setup and institutional capital flows. Institutions absolutely do not deploy capital without a macroeconomic catalyst, and right now, the global landscape is forcing a massive structural shift in how large portfolios allocate risk. We are witnessing textbook late-stage risk-off characteristics across the broader market. There's this massive spike in volatility, with the VIX up nearly 9%, while equities, Bitcoin, and precious metals are just bleeding heavily. Large, sophisticated capital is fleeing risk assets and aggressively seeking the ultimate safety of cash, specifically the US dollar. This global flight to the dollar creates a severe structural headwind for gold. When capital flows so decisively into the buck, it systematically starves risk assets of the liquidity they need to sustain any meaningful upside expansion.
And the macroeconomic data firmly validates this dollar strength. Look at this massive non-farm payrolls print of 172,000. It absolutely shattered the consensus forecast of 85,000. On top of that, the broader unemployment rate held entirely steady at 4.3%. Now, if you're an institutional portfolio manager, this incredibly resilient labor market gives the Federal Reserve all the fundamental justification it needs to hold terminal rates higher for a much longer duration. Sustained elevated real yields make a non-yielding asset like gold structurally toxic for large portfolios in this specific macro cycle. It's applying continuous downward pressure.
Moving on to Section 2, smart money positioning. Let's reveal what the COT data is actually telling us.
With that macro headwind established, we need to focus on internal capital distribution. The disaggregated commitment of traders report shows us the exact footprints left by smart money behind closed doors. This data exposes the structural distribution phase currently underway. Swap dealers have heavily added over 18,000 short contracts. These are the large commercial entities, the true deep pockets of the market, aggressively hedging against lower prices. Meanwhile, managed money, representing institutional speculators and trend followers, actually added over 5,000 longs while simultaneously covering their shorts. And crucially, this massive accumulation of longs happened right before the violent Friday NFP drop. Managed money aggressively bought into a premium dealing range, completely trapping themselves at the highs right before the market was algorithmically engineered downward.
This dynamic right here illustrates the ultimate trap in the marketplace. The retail focus is squarely on catching that falling knife, blindly buying panic drops at perceived historical support levels. But historical support is often just an illusion engineered by the algorithm. Institutions are actively distributing their heavy short inventory into this artificially engineered retail buying pressure. They're literally allowing retail traders to step in and create the buy-side liquidity that is absolutely required to execute massive sell programs without disrupting the tape. All right, Section 3, institutional market structure and algorithmic price delivery. Macro pressure and bearish COT positioning ultimately have to manifest on the tape. Decoding the institutional market structure reveals the exact algorithmic delivery of this massive distribution phase. On the daily time frame, price stalled precisely at a premium resistance block, showing a clear failure to sponsor higher prices. That psychological failure was immediately followed by a sharp, violent displacement lower. When we drop down to the 4-hour time frame, the institutional footprint becomes absolutely undeniable. We get a pristine market structure shift accompanied by successive breaks of structure strictly to the downside. The algorithm has clearly transitioned its objective. It's no longer seeking higher premium prices. Instead, it is aggressively hunting discount liquidity to the downside. The internal mechanics of this move are incredibly visible on the 1-hour time frame. During the Friday New York session, the market continuously engineered clear market structure breaks, but more importantly, this aggressive downward expansion left behind clean fair value gaps. Now, these imbalances aren't just random spaces on a chart, they represent sheer algorithmic displacement. They create structural voids in liquidity that smart money will inevitably return to, using them as mitigation blocks to load even more short positions for the next leg down. Let's head into Section 4, Liquidity and PD Arrays, mapping out the institutional landscape. Displacement leaves clues, sure, but algorithmic price delivery always seeks a destination. Capital continually moves from one liquidity pool to the next across the institutional map. The current liquidity landscape is strictly defined. Above the market rests the buy-side liquidity, concentrated heavily above 44.50. This pool is made up of trapped shortstops and emotional breakout buyers who are currently underwater. Below the market, the immediate sell-side liquidity is just waiting to be swept beneath Friday's lows at 43.20. However, the true target for algorithmic delivery lies much deeper within a historical daily liquidity pool. The ultimate draw on liquidity sits precisely at 4,270.90. This specific level represents a massive historical pool of equal lows. You have to understand, the algorithm didn't break Friday's structural lows simply to reward early retail sellers with an easy trade. No, it deliberately engineered that drop to hunt the massive pockets of external sell-side liquidity resting exactly at this historical boundary. This is the ultimate objective where institutions intend to confidently cover their massive short inventory. Finally, Section 5. Let's map out the execution plan based on probability and logic. Having aligned the fundamental bias, the bearish market structure, and the exact draw on liquidity, we can formulate our execution plan based entirely on probability. Professional execution relies on strict protocol, never on chasing price into a deep discount. Our execution relies entirely on algorithmic repricing. We are waiting for a structural retracement back up into the 1-hour bearish fair value gap, located between 43.80 and 43.95. Risk is strictly contained, with invalidation placed securely above the 4-hour breaker block at 44.25. That protects our capital if the bearish structure unexpectedly fails. We then scale out dynamically as liquidity is swept. The first target sweeps Friday's low at 43.18, and the final target scales out at our major daily liquidity objective down at 42.75. Liquidity moves markets. Smart money moves liquidity. It's really that simple. If you only follow price, you're constantly reacting to a narrative that's already been written. But if you learn to follow liquidity and institutional order flow, you're anticipating the next chapter. The market always rewards rigorous preparation, never emotional prediction. If you want weekly institutional gold analysis utilizing ICT and smart money concepts to stay aligned with the algorithms, make sure you subscribe to ICT Trading. Thank you for watching this briefing, and I'll see you in the next one.